Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Joining us today to discuss what's shaping the global bond landscape is portfolio manager Peter Kahn. High-yield bonds and other credit assets have generally provided greater risk-adjusted returns for investors, and Peter explains today how he's been navigating the landscape to provide investors with a good cushion. So why might now be a good time to buy high yield on the current market weakness? And which strategies is Peter using for today's market cycle? Stay tuned for Peter's discussion with host Pamela Ritchie. Today's podcast was recorded on August 28th, 2024.
Hi, Peter. Great to have you here.
Hi, Pamela. Good morning. Thanks for having me.
Delighted to have you join us here at Fidelity Connects. Let's begin with how you see the world from your purview. We look like we're at the beginning of an easing cycle. Why is that important for high yield and what you're doing right now? What will it affect in theory?
Yep. So the tailwind of Fed easing is always welcomed by the risk asset investing community, and high yield is no exception to that. What it means for high yield companies is actually perhaps a little bit of relief in borrowing costs. Spreads have already tightened quite a lot this year, as many investors will know, but the all-in cost of financing still remains pretty high relative to where it was before COVID in particular. And quite a few companies out there have been watching and waiting for the opportunity to refinance debt for a longer period of time with lower coupons. So we're actually expecting issuance to pick up quite a lot as the Fed begins to ease.
That's really interesting. So what are the companies that we're talking about when you're investing in companies issuing high yield debt? Who are those companies? What are we talking about?
Sure. Well, it's actually a wide variety and a well-diversified asset class. Right. So it's broad, it's deep, and U.S. high yield in particular offers a good amount of sector diversification. So kind of the heavyweights in our market are the energy sector, the healthcare sector, telecoms, media, technology, and the loosely named services, which just about anything can fall into. Plus, you've got representation from basic industry, chemicals, financing companies, et cetera, et cetera. So it really is a microcosm of the world. And the high yield, for investors maybe a little bit more familiar with the equity universe, tends to be pretty well correlated with the Russell 2000.
Okay, great. Two questions there. One, is high yield just U.S. and Canada? Is it a global story?
It's definitely, there's a lot of US and Canada,
right.
But it is a global story. And that's evolved over the course of the last decade or so. So even before the GFC, global capital markets were picking up and taking notice of what was happening in the US. So the leveraged finance market, which we kind of refer to as the combination of high yield and leveraged loans, was, let's say, 80%. U.S. and Canada.
On zero interest rates.
On zero interest rates, and kind of stayed that way for a couple of years after the GFC. But as time has been going on, markets are deepening and evolving, particularly in Europe. So the U.S. weight in the global market is now down to about 55%.
Back to somewhat correlated to the Russell 2000, let's talk about the story of risk. How this fits as a more risk-adjusted approach for investors than perhaps equities, because as you say, generally high yield's doing well, equities are doing well. So there's sort of that why equities versus high yield back and forth.
Yeah. So, what it boils down to is the combination of, a great income stream, because the high yield total return in the asset class over the life is really generated by the coupon, right? The best thing that we can get as high yield investors is, get a company that pays their coupon, maybe improves the balance sheet and sees credit ratings improve and see some spread compression in the meanwhile from a trading perspective. But for a very long run investor, you're hoping to get your coupons and your money back. Maybe a bigger fish will come along and swallow you if you're kind of well positioned in your industry. An IG company, investment grade, I should say, company might come along and decide to acquire you, at which point your bonds might get taken out at some kind of a premium. But that's what you're looking at in high yield. So you're kind of sacrificing upside relative to equities in exchange for certainty and a better standing in the capital structure, because the debt, in theory, wind up will come before the equity.
And the companies that would be IG or investment grade, bigger companies, bigger fish, for instance, do they also issue high yield? I mean, you do see that sometimes.
Yeah, there are lots of household names that have spent their time in the high yield market, whether by choice or by accident. So a couple of names that are very well known household names, such as Ford or General Electric, have spent some or a lot of time in high yield as they struggle with changes in their industry and the way that their businesses run. There are some other superstars of today's marketplace that were born as high yield companies. So Netflix and Uber, which recently rose up to investment grade status, started out as high yield companies and utilized the leverage finance market to help fund their growth. But there's a lot of other stuff in our market that doesn't have such either familiarity or a favorable growth profile too. So we need to be careful where we pick and choose.
Yes, and I'm sure that's what your massive research department helps you do. Let's talk about spreads a little bit. Talk about they've tightened. We've seen that. For someone who might be looking for exposure within their bond side of the portfolio, just sort of speak about the spread story.
Yeah, so spread generally for credit investors is a good thing because it provides a cushion relative to whatever your kind of reference risk-free rate is for all of the world. Just like high yield, we're pinned to treasuries when we talk about spread, and so that adds an element of sort of a shock absorber, but it also adds an element of a different duration profile. And without getting kind of too technical. And starting to sort of witter on about things like empirical duration. The duration of the high yield market is low, either when it's mathematically measured or when it's been observed. It's not always static, right? Because it can change. It has sensitivity, given a lot of high yield bonds are issued with call features and a call schedule. So there's an optionality embedded within there, which leads to some changes in those sensitivities to duration over time. But generally, the duration of the high yield market in terms of global credit and then relative to government bonds is very low, right? The only thing that's lower is leveraged loans because they're 100% floating, right? So investors who are looking for income without interest rate sensitivity often find themselves considering credit.
So when a company wants to raise cash, they're going to high yield markets. There's also those swimming out there in streams on the PE side of things. There's different ways to raise cash. The companies have lots of different options of how they sell or buy or raise cash. Just talk to us a little bit about sort of the competitors within the space, the different plays that there could be for some of these same companies that are issuing high yield debt.
Yeah, sure thing. Definitely for the bigger names in our space, they have a strong choice between choosing bank loans, high yield bonds, equity markets, because by number, about 55% of the U.S. high yield market are publicly traded, so 45% with private sponsors. So those with 45% private sponsorship don't necessarily have the ability to go hit an equity ATM or issue a convert, but these days with sponsors flush with cash, they can go knock on the door and see if they can get some sort of extension or additional injection from their sponsor, or increasingly, whether that's sponsor adjacent or completely independent, the pool of investors looking to invest in private debt is that's the real change over the course of the last 2 years, with the huge influx of interest, demand, and cash into that space. That's created a lot of competition, even for companies with bigger earnings profiles than you might expect. Because I think the private credit market started out lending to companies that might do annually 25 million, 50 million in EBITDA, but now they've got their sights set on companies that are much larger than that.
That's really fascinating. So how does that affect high yield one way or the other? It just means there's more competition. Is that basically what it is?
It does. It led to kind of a combination of factors led to a paucity of supply over the last couple of years, right? Firstly, what we talked about before was, higher rates and wider spreads meant companies were sort of choking on the cost of going to the market, so they decided not to. Secondly, the ease and facility of taking a look at some of those markets, meant you didn't have to get a rating, you didn't have to do documentation, you didn't have to do a global bond roadshow. You could just do a bilateral negotiation. We cut a deal, we're done, we're happy. And that way I also, as a company that might be a little bit cynical about what happens to them if things don't go well, times get tough, then I only have to negotiate with you. And I don't have, you're unlikely or probably unable to sell your private credit investment to another investor, which means, from my perspective, some vulture hedge fund can't swoop in and all of a sudden have a controlling stake in the debt and determine my destiny.
So that's so interesting, because that has been the world. And as you say, there have been some choke points. We've seen interest rates rocket, obviously, huge pace, and now sitting at 5%. But we are on the cusp of something very, very different. So ultimately, the opportunities in high yield start to shift, do they not? Tell us about that.
Definitely they do. And what, kind of the quality of assets that we prefer associated with an easing cycle, should, change, or we definitely need to be thinking about whether they should change in the face of why we're easing rates. But I think that's the key point, right? Because we know there's a lot of cash out there on the sidelines. Right. We know that easing should be triggering either a trickle or a flood of that cash back into markets, but it's super path dependent, right? If the forward curve has got 175 basis points of cuts priced in for the U.S. Federal Reserve over the next, say, 18 months, that's already pretty aggressive, and plenty of times in the last couple of years we've seen the curve get a little bit ahead of itself, and then lo and behold, the economy is resilient. We don't need to ease that much. We're not about to tip into recession, and the pendulum swings back quite violently. So I think we need to bear that in mind too.
Just keep that in mind. We don't have a firm grasp. No one does, because it's all data dependent. Coming back to some of those big sectors that you take a look at. So energy, you mentioned healthcare, also sort of media, telecom, and so on. Again, these are big companies that in most cases have their pick of how they want to raise debt and have any sort of origination. How are they looking, these sectors right now? How are they different to the way they were, and maybe different to how they need to fund themselves? But I mean, energy certainly is different.
Yes.
Media is being transformed. There's a lot of disruption. What does that mean for you?
There is. Well, it means opportunity,
It
really,
does.
for us
Right.
in the first place. And that's the advantage, I guess, of being, Fidelity with global reach, global network. We can compare, contrast things across regions and dip into the expertise of both our credit analyst team and the equity research team to think about and model through scenarios for how these companies can survive or thrive in the current environment. And from the high yield investor perspective too, we also clearly want to avoid the stuff that won't.
Right.
So
Any thoughts on what won't?
Well, without getting into specifics, right? I mean, to characterize it, the sectors that you just referred to there, right? Energy is currently expensive and defensive. It hasn't always been that way. Right. Maybe someday will come again when they're in a drill baby drill sort of mindset, and they're also thinking more about shareholder returns than quality of balance sheets. Mm-hmm. But we don't expect that to kind of environment to evolve anytime in the near future. The rest of the space is quite bifurcated, if you will. So tech, right, which has been using leveraged finance in a growing sense over the last couple of years, and is really big in the loan market. It's a little bit less so in high yield. You've got a number of names now that are trading at super tight spreads, like almost or through the triple B index, which is the kind of weakest layer of investment grade, but up in quality relative to high yield. These names, whether they're tied to the, kind of data center trade or the AI trade or whatnot, they're all enjoying that and have super skinny spreads, don't offer a lot for investors looking to generate a capital gain, but also unlikely, if something does go bump in the night, to really blow up. And in the middle, you've got a lot of old legacy businesses that are dealing with disruption, change, regulation, shifting demand trends.
And these are ones that haven't righted themselves. You can think of some big industrial household names that actually went through some issues but have sort of righted the ship.
Yeah.
There's still more to go.
There's always something to go,
Yeah.
right? And it's just a question of which industry it happens to be focused upon at the time.
Where are they now?
Well, a lot of debt has built up in the media sector, in particular, cable and linear TV. There's some, highly indebted companies out there with chancy growth prospects. Some of them, though, have nice ability to generate good cash flow out of what used to be seen as utility-like, kind of business profile,
Yeah.
but now is getting fragmented by technology.
Okay, fragment, yes. I mean, it's interesting, particularly with sort of media. There's certain industries that have been kind of in a sunset mode, but let's talk a little bit about, I think you mentioned this term earlier when we were speaking, this melting ice cube story. And I don't know if it applies directly to that, but this idea where you've seen disruption eating away and things going a bit slowly. Things seem to be going quite fast now in certain industries. I'll let you illuminate which industries those are, but yeah, that's happening.
Yeah, for sure. It's happening, and it's definitely like the pressure point for that is in, say, mobile communications and cable TV and broadcasting TV. I mean, I think that's where a lot of the action is at the moment. There's some very large distressed capital structures that are out there on both sides of the Atlantic that are, currently undergoing some, extensive rounds of negotiation as to try to figure out how these things can be reconfigured and reshaped so they can survive and buy themselves enough time to figure out a new business model of the next, sort of 5 or 10 years.
And that rejigging and is part of that is high yield?
Part of that is a lot of that is high yield.
A lot of that
Most
is high
of
yield.
that is high yield.
Yeah.
Some of that is still investment grade and may find its way to high yield over the course of the next year or two.
So those are interesting industries for you right now.
They are, for sure, because I mean there's always, I'm a trader by background, and for me that means a few things, but first and foremost, there's a price for everything, right?
Price for everything.
When you see credits that can generate a reasonable amount of cash flow over the next 2 to 3 years, certainly enough to service their debt, probably enough to delever. When they have other levers to pull, assets to sell, or different sponsors to tap into, then when those names start to trade wide of the high yield index or subsets of the high yield index, and double Bs in particular, where we're talking about fallen angels as names that were investment grade that wind up in high yield, they tend to trade 75, 100 basis points wide of the double B index as they're descending into our space. And for us, that's an opportunity.
Fabulous. Okay, we're going to talk about more opportunities here. There's some great questions coming in. You've answered all of them, so just say you've already done a whole bunch of that. Let's talk a little bit about what's embedded in what the market seems to think the easing cycle will look like, in terms of it'll begin next month, which is only a few days away, and then we'll go in some version of steadiness until we come back down to maybe 3%. We don't know. Nobody really knows. How realistic is that to you? Does it seem unrealistic? Does it seem bang on? It's the soft landing story.
Yeah, well, I mean, who am I to argue with the market, right?
Actually, you're probably a pretty good person to argue with the market.
But I do think that we've gotten ahead of ourselves in the course of the last couple of weeks, being concerned about growth really falling off a cliff in the U.S. So
it's not falling off a cliff.
It's not falling off a cliff, but it certainly is slowing.
Okay.
Problem, compounding matters is the fact that we have a binary event coming up here in early November, which will have significant implications for the path of policy, the impact on different sectors, the independence of the Fed, perhaps at stake too. So that's
How do investors get ready for that? Like, what's the safest place to hide is the wrong word, but just is it just diversification? I mean, is that the answer?
Yeah, diversification is always a good thing.
Yeah.
Of course, when things get stressed or stressful, cash is king. And cash is still very competitive relative to, say, front-end treasuries these days, right? Because of the fact that we are now expecting so much easing. You see 2-year treasuries are coming down well below 4%. A T-bill is still north of 5, right? Difficult to say what might happen in 3 or 4 months, but depending upon how the pendulum swings in sentiment, people might just park in cash for a little while.
But you park in cash inside sort of a bond fund that's ready to, when the dry powder moment comes, apply it.
Yeah, you don't want to sort of drive yourself into a cul-de-sac here, right? I mean, that's one thing that we've certainly learned over the course of the last few years, is that you need to be flexible and adaptive, and the little volatility storm that markets had to endure.
Yeah, just little.
Yeah,
tiny.
Just a little one.
Just a little one, yeah.
Back there. What was that? It feels like 3 years ago, but it was 3 weeks ago. Plenty of these episodes could still, emanate. But if we do go along the sort of base case of soft landing, that implies that growth isn't going to slow down much more, that the unemployment rate in the U.S. probably won't exceed, say, 4.5%. Let's leave implications of the election aside, and immigration, change of pool of labor, et cetera. If we're in that kind of environment, 175 basis points may not necessarily be justified based upon what we've just observed in the last 2 to 3 years.
And absorbed, right?
Each economy is, differently wired, and the U.S. is maybe more attuned to long-term rates than most of the other G7 economies.
Right.
And we've also, it's very difficult to sort of parse out, the influence of that lack of sensitivity, and then the influence of fiscal stimulus, the influence of monetary stimulus. But we're going to find out in the course of the next, say, 6 to 12 months, just how important some of those factors were.
Right, in keeping us afloat and keeping us somewhat insensitive to interest rate hikes as a broad statement. This is your thought, but I think all of us are a bit surprised that things haven't been more crushed. There are pockets where the crushing is happening, no question, but as a broad story.
Yeah. From the capital markets perspective, certainly. It's been very impressive. We were skeptical, many others were skeptical. We remain cautious because that sort of deep and meaningful impact of trailing, rise of rates and the widening of spreads for lower quality companies in particular. We're dealing in, kind of a public market effectively with a reasonable amount of transparency, but there's clearly still a deep amount of pain amongst the small and medium enterprise sector, which relies almost exclusively on floating rate financing. A lot of pain in, other segments of the market like commercial property, which I think we're well aware of, that just need to sort of work themselves through, which that's a brake on growth for sure.
But it could, in theory, roll through sort of piece by piece rather than all at once.
Yeah, exactly. Exactly. The sort of a lack of a contagion trigger for systemic risk, I think, has been one, benefit of a diversified economy, diversified systems. If you had to, I don't want to, rudely cast aspersions at any one, country or geographical region at the moment, but if you look at the contrast between China, which was the engine of world growth.
Let's talk about China. Yeah. It got us through the post-GFC period in many ways.
It did. And basically, levering up of the entire Chinese system kept the world afloat and, had a major benefit for emerging markets and facilitated transformation of the Chinese economy that many still think is quite, incomplete, having moved from an export-based fixed asset formation-based economy to more of a services economy, to make that transition from low income to middle income to high income system. They're sort of still trapped in that purgatory of middle income and dependent upon fixed asset formation and exports, right? You can see it, now, like what do they need to lean upon in order to make sure that growth doesn't really implode in China? It's been exports. The other big factor and problem right now is the property sector and the heavy dependence on the property sector over the course of the past 5 years running up to COVID, where its share of GDP hit low to mid 20s. That's excessive.
Yeah, and with China muted in the global economic picture because of those reasons, What opportunities does that provide? I'm going to go straight to high yield, but broadly, there's an economic story there. But what does it actually mean for sort of the capital markets in other places?
Yeah, well, I mean, it's led to a slowdown in the use of capital markets from kind of Asian companies for a few years now. That we're starting to see a little bit of a renaissance and a return of some of those companies to the market, and a clear bifurcation between, say, India and China, or Indonesia and China, has led to some companies in those markets being able to access dollar funding at levels that they probably never really would have imagined, if you just painted this picture for them. Other emerging economies that have been dependent upon exporting into China raw materials, and companies that have been built for that, some of them have managed to evolve, and if they're well managed enough, they can survive it and find ways to thrive. Or if they're lucky enough to be in certain industries like basic materials, given the AI boom,
sure,
the demand for copper out of that space, people are more focused upon that and its use in green energy or hybrid vehicles than they are in Chinese construction anymore. So it depends, I guess, is the facetious answer.
Does it lead to it's a tricky story right now, global trade, but does it lead to more potential for global trade hanging on because China might need to do more business to keep themselves afloat?
Yes, I think so. I mean, I think generally the narrative is a little too bullish, on let's say, deglobalization. So that's a strange way to put it, I suppose. It's probably more easier to say
we might trade more.
We're too pessimistic about trade, and trade is still sort of chugging and churning right along. And the resumption of trade is something that's created some additional kind of upside in the post-COVID recovery.
Okay, that's really fascinating. So tell us, what would you like to sort of make sure investors know about this particular area of high yield at this particular time, where there are a lot of questions out there, but there seem to be opportunities for risk too, to get on the risk train for those that have the stomach for it and the appetite. There seems to be a good case for going with risk. Make the case for high yield.
So, I mean, high yield is a great little asset class, right? Because it's got the nice combination of a good, solid, real income stream, and that low duration sensitivity, and generally a low volatility profile over time. So, past performance is no guarantor, et cetera, but looking back over the last 20 years, the high yield risk return ratio, Sharpe ratio, is more or less 1, right? 8% returns, 7-8% volatility. Volatility now is super low. Looking at the asset class, it's down to low to mid single digits. We wouldn't expect that to last forever, but some investors who expect that to last for a little while can look at here's something with a 7% plus yield and a volatility of 3. That looks pretty, tasty from an asset allocator's perspective. So
versus one of the questions coming in, which you mentioned at the front of this conversation, high yield versus investment grade opportunities. I mean, it's a difference in yield.
It's a difference in yield now. 18 months ago, the front end of the investment grade space was very, very attractive indeed. Right. When the Treasury curve was inverted and spreads were widening, you could buy 3 to 5 year IG paper in the 6s and 7s. That was a slam dunk then. Some people are maybe wishful that might happen again. If it turns out that the economy actually isn't slowing at all, and financial conditions are too easy and the curve backs up a little bit, spreads may widen at first, and there may be another window of opportunity, maybe not to create those sorts of returns, but a good one. Now we're in a space where, typically when the Fed is easing, treasuries win the race, IG follows, and high yield follows behind that, right? Just from the basis of that duration sensitivity. It's the duration factor that kicks in first. Also, we tend to see in that environment, though, you're going to have people rotating, as time goes on quite quickly. As treasuries trade already 150 basis points through cash rates, as IG gets deeper through cash rates, money will ultimately trickle down, particularly now that high yield, the market composition isn't the highest quality it's ever been. That was 2 years ago, but it's still very high relative to history. So the embedded risk of default of the overall market right now is just about as low as it's ever been. And if you're capturing a nice spread relative to investment grade, then more and more people are willing to do that, and that's been keeping demand for high yield kind of pumping over the summer.
It's fantastic to have you take us through a look at this market. Thank you very much, Peter, for joining us here today.
Pamela, it's been great to be here. Appreciate it. Look forward to speaking again sometime.
Yeah, absolutely. It's Peter Kahn joining us here on Fidelity Connects.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments